look, offense wins games and defense wins the championship. So when you're in your younger years playing offense, putting that money in there, being much more aggressive, putting, maybe 100% of your assets in the stock market. And then as you get towards retirement, you're going to want to play some defense and protect some of what you've created.
And welcome into Your Game Plan for Retirement, brought to you by McIntire Retirement Services, your weekly reminder of all of the things that are important with your money, your finance, your investments. Of course, brought to you by McIntire Retirement Services, and your source for the information is President, founder of McIntire Retirement Services, Northwestern Ohio's resource for that common sense approach to planning for your financial future. He is Chris McIntire. Always a pleasure to have you here on the program. Catch up with you, Chris, and as you normally do, keeping us on track with a tip of the week to start the program.
Yep, and we're going to call it the triple P's here. Planning prevents panic. And as we've seen here lately, obviously a lot of volatility with the stock market given the Iranian conflict going on over there. And despite, all of the, let's call it the success of the American and Israeli military and taking down a pretty violent regime here, that if you're planning, having your investments set up the way you want them to be set up to be able to handle the volatility, it will help you prevent panicking and hitting the sell button because your account went down 3-4% and all of a sudden you got out and you miss it when it runs up another 7 or 8. Okay. So planning prevents panic, buddy.
Yeah, absolutely, Chris. And if we are going to be invested to take advantage of the growth opportunity that the market provides us, the question can't be, how do I avoid volatility? Volatility is inherent. It is a part of the market. The question should be, Chris, if we've got that plan in place, how do I prepare for it? How do I protect against it? And again, according to our plan, maybe even how do I take advantage of volatility when it happens?
Yeah. So, Peter, I got 100% of my money in stock. So, we've taken a pretty good, value drop. If you look at it, the percentage isn't much, but the dollar amount seems like a lot more, right? And, the way we do it for our clients is, and most of our clients have a nice safe money strategy. So when these things happen, we can either rely on the safe money strategy to use it as income if they need it. If not, we can pull some money out of that safe money strategy and add it back into the stock market and take advantage of the volatility. That's planning.
Yeah, and if you've got that plan in alignment, if you understand the risk exposure that you are comfortable with and the plan matches that and mirrors that, if you understand your time horizon and the purpose for each dollar, then maybe volatility is not something that causes that emotional reaction or making mistakes on the wrong moves at the wrong time, which our psychology leads us to. That's what we'll be talking about on today's program. Market volatility, how to understand it, defensive moves, opportunities, how to be prepared, ladies and gentlemen. And of course, the plan is going to help you do that. And the most valuable opportunity here on the program is to get your plan put together. If you would like Chris McIntire, the team from McIntire Retirement Services, to help you construct your game plan for retirement, then just start that conversation with a phone call. There is no cost. There is no obligation to getting your game plan for retirement put together. 419-332-0532, 419-332-0532, 419-332-0532, or online at McIntyreRetirementServices.com, McIntyreRetirementServices.com. So again, today talking about volatility, how to prepare for it, to understand it, defensive moves, and even how to identify opportunities. But Chris, let's start with that 30,000-foot view. What is volatility and what causes volatility?
Yeah, so let's turn the clock back to 2025, just about a year ago when the president announced, tariffs on everybody, basically. That was very volatile. We saw, I think, a 15 to a 17% drop in most of the major stock market indices at that time. We saw some pressure on our U.S. government bonds, from retaliatory responses from some of our trading partners. That's volatility. Okay, uncertainty, right? So that's probably another name for it. Obviously, we just have had Israel and the United States with the attacks on the Iranian regime there. That's volatility because it closed off the flow of oil and spiked oil. So volatility, uncertainty, not knowing what the outcome's going to be. And most of the time, a lot of the volatility here has been short-term volatility, not long-term volatility. Long-term volatility, let's go back to like 2000, the original tech bubble, 2000, 2001, 2002, significant long-term declines in stock market indices. The 2008 financial crisis, right? That was volatility there. The government stepped in significantly and helped to rescue the economy. Obviously, a lot of economic damage was done there. And then we'll go to 2020 with COVID, right? Lots of volatility as everybody shut down. Government came in even faster than they did in 2008 to help rescue. And we certainly saw record highs in the stock market with all that stimulus. That led to a lot of inflation and rising interest rates. That led to more volatility because rising interest rates hurts the bottom line for corporate America because borrowing costs go up. So some recent examples of short and long-term volatility, buddy.
Yeah, so economic uncertainty, interest rates, sectors of the market collapsing, the housing, inflation concerns, geopolitical events, something out of the blue like COVID, legislative changes. All of these things can cause volatility. But Chris, I'm thinking back to all those examples that you mentioned, and the panic was real. The market declines were significant. But if I think back to the dot-com bubble, the market is higher today, significantly higher. If I think back to the Great Recession, the market is higher today, significantly higher. COVID, the market is higher today. All of these events that caused panic for investors, if we sold out during that time because of those declines, we sold into those declines and locked in losses, and we've missed out on all of this fantastic growth that's happened since then.
Yeah, absolutely. And where we say planning prevents panic, let's go back to the more planning side. You and I were talking before we hit the record button here today about a particular company coming out with an initial public offering and how do we get into that. So we want to get in. We're doing some planning here. Peter had some good advice on that we can't share publicly, obviously.
But
On the radio.
call if you'd like to know, right?
Yeah,
419-332-0532. We can talk about if it's right for you and how to access that.
Yep, absolutely. And so like even in this recent dip in the stock market after the Iranian excursions or incursion, whatever you want to call that, the conflict, hey, if I've got some money on the sidelines, do I want to bring that in and take advantage and buy the dip, for example? So, planning prevents panic. So we didn't have to get out of the market. And then back to the planning side is, let's go to, we call it 3WD. What would Warren do? What would Warren Buffett do if the market fell 10%, right? He would most likely find some opportunities and put some capital to work for long-term appreciation. And as Peter said, look at where we've come through some of these crises. So it's not about timing the market. It's about how much time you spend in it. And then when is the time maybe to add some more to it?
And something along the lines of, I'm not quoting it word for word, but Warren Buffett has a pretty famous mantra or motto that when everyone else is panicking, that's when there's the greatest opportunity. And so if we've got a plan that's giving us the guidelines, Chris, that's keeping us aligned, that's giving us the vision of where we want to go, and we understand how much risk we're willing to take. The volatility that is going to be a factor in the market is going to be inherent, is going to be experienced, can be that opportunity. However, Chris, I also want to dive into another very important point that you've got outlined here, which is that volatility feels very different in retirement. And can you talk to us about the difference between volatility in our working career versus once we are retired and why we need to plan and prepare for that specifically?
Yeah, absolutely, buddy. And I'm going to have my 61st birthday here by the time the show runs its course. And, so I understand it a lot more, as you get, later on in life than you do when you're Peter's age, like 32 or something.
Not
And
quite.
not quite, but
Not quite. Yeah.
yeah,
Full decade and a half past that one, Chris.
sure. We've often said many times, Peter, that, look, offense wins games and defense wins the championship. So, Peter and I are huge hockey fans in football. Peter's football fan, basketball fan as well. And, when you're in your younger years playing offense, putting that money in there, being much more aggressive, putting, maybe 100% of your assets in the stock market. And then as you get towards retirement, you're going to want to play some defense and protect some of what you've created so that you can rely on that as your income stream stops and you have to start that out of your investments, Social Security, pension, dividends, interest, annuity payments. That's a lot different than clocking in every day, Monday through Friday, and every other Friday you look at your bank account and somebody put some money into that. So, it is certainly a much more emotionally charged time, especially as for those that are just coming into retirement, and they see this crazy volatility, and all of a sudden they look at their investment portfolio and they're like, "Oh my goodness, why I should have kept working," right? Those are the things that can run through your head.
Yeah. Well, another sports analogy, talking about offense and defense, which seems appropriate here on your game plan for retirement. But Chris, that good defense creates offense, and that's why having some defensive strategies at times can be an effective offensive play as well. But Chris, in retirement, the direction of our money changes, right? We are putting money in, we're making contributions, we're dollar cost averaging, we're accumulating. In retirement, we are making withdrawals, we're creating income, and the direction of our money might matter as much, if not more, than the direction of the market day to day.
Yeah, yeah, great analogy there, Peter. And I like dividend paying stocks that we utilize for a lot of our clients. We like bonds that pay interest, so that's getting work for our money. And, take a dividend paying stocks like utility companies, many of the energy companies, the banks obviously pay a lot of good dividends and whatnot as well. Is, even if the price of those stocks are fluctuating up and down in value, if they're good quality companies, you can count on that reliability of the dividend. And then you don't have to worry so much about the stock having to appreciate in value so that you can sell some of it to create your income, right? You're getting paid profits of the company. That's what the dividends are. And, there are many good quality companies that have a very long track record of increasing their dividend payouts. And, that's a perfect win for a lot of investors in retirement, and that's just one strategy: stock dividends, bond interest. You can, certainly, find a good quality insurance company, structure an annuity payment, that's got contractual guarantees from some of the largest companies on the face of the planet to continue those paychecks. So a lot of different strategies that are out there. We use structured notes, which are, we need a radio show to probably explain some of those, but, those are high yielding instruments with a degree of protection around them as well. And it's probably safe to say, look, insurance companies are as sound as their financial backing, right? Banks have FDIC insurance, so that's why you need to work with somebody, who's used to working in this environment and can select good quality companies, to put your, what you've worked your entire life for, and how to make that work best for you.
Well, several defensive strategies mentioned there, and an overview of how to deal with and plan for the reality and inevitability of market volatility, and avoid sequence of returns risk, specifically when you are retired and making withdrawals and depending on that income. Very different in accumulation years versus the distribution years. Distributions changes everything about market volatility. So defensive moves during that time are going to serve to protect your plan. If you'd like to find out more about any of those strategies, if they are right for you, if they're appropriate for your financial approach, pick up the phone and give Chris McIntire and McIntire Retirement Services a call. 419-332-0532, 419-332-0532. 3-2. Chris, a few more defensive moves to provide some protection, more traditional type of moves. You mentioned diversification and rebalancing and just de-risking the portfolio to plan for liquidity during volatility.
Yeah, absolutely. You could say, we talk so much about stock and bond markets, and gold has been very, very popular these days, but those aren't really the same.
Very volatile short term as well, though, right,
Yeah.
Chris?
Yeah, absolutely. And I just wanted to throw that gold precious metals in there. As good as they've been, that is not a more of a defensive play. That's more of an offensive play. So our defensive plays that we utilize, you could say a bank CD, right? That would be defensive. Money market account. The risk there is on the inflation side, right? If oil's $100 a barrel, yeah, you might be protecting some money here, but is it, you're still losing it to the potential of purchasing power. We do a lot of 3 and 5 year fixed annuities, and locking in good rates of in that 5% range for 3 to 5 years, and plus or minus a 0.5% depending on the company. We use the index annuities where when the market goes up, you can participate in some of the gains of the market, but when it goes down, you're protecting your principal. So, if we look at the growth side of the ledger and the safe and secure side of the ledger, does provide some very high quality options, that you're not going to find in your traditional 401k retirement lifestyle 2026 fund. Some of these things aren't always available in your company plans. And that's why when you work with somebody that specializes in this field, you get access to, some things that you cannot buy on your own.
Chris, during our working years, our paycheck provides the defense. And in fact, if we're earning money and we have the ability to invest and contribute, those moments of volatility are a significant opportunity. Dollar cost averaging, one of the fundamental principles of investment success. The fact that income is primary in protection does not change in retirement. The direction of our money does, but a income first focused type of plan, income protection, might be one of the best retirement defenses against panic during volatility.
Yeah, absolutely. As try to steer away from these headline driven decisions to, sell at the worst possible time, if you're, staying true to your core, you got an advisor that's talking you through some of the emotional aspects here. You might even be bringing some money in from the outside and taking advantage of the dips in the market when that happens.
But Chris, like things like Social Security and pensions, you mentioned annuities, separating income from market performance is an essential step in planning for retirement to deal with the market volatility on the growth assets that we do have.
You're right. Structuring that solid income that you can count on, regardless of what's going on in the stock and bond market, certainly provides a lot of peace of mind. And look, you've worked your entire career. You deserve to have that peace of mind. Our good buddy Dave Gaylor, used to say, peace of mind is quality of life. It's a stress reducer, and stress, is obviously something that's very detrimental to your long-term health. And, Peter and I can tell you that because we work in the stock market. So we know all about the stress and, what it does to, clients and whatnot. We help them steer through those emotions and remove those key stressors.
And in fact, Chris, there were studies done a number of years ago that showed retirees with that income plan in place actually lived longer and happier retirements.
Yeah, Dr. Wade Fowle, we've had him on the show way back in the day. I just was watching him on LinkedIn before you and I started to record. He's a PhD and he breaks down, that having that reliability of the income actually improves your health overall. And, I know some people aren't big believers in the annuity side of things, but my goodness, guys, the numbers don't lie.
Yep. And another well-known guru in the retirement planning world, Tom Hegna, talked often about the happiness factor in retirement. He wrote that book, Don't Worry, Retire Happy, and the fact that guaranteed income provides for that contentment, that security, that confidence, that quality of life that David Gaylor also talked about.
Absolutely. Yeah, I love Tom Hagnight, and I can't wait to hear him speak at one of our conferences. Again, it's been a few years, and he had the book what was it, Paychecks to Playchecks.
Yep.
And retired military guy. His son is still in the military. I think he had a tribute to him here recently. So, we want to thank those guys for their service, and all of you out there that have your family members might be in harm's way. Let them know that we think of them and pray for their safety. But we love listening to Tom Hegna, Dr. Wade Pfau, some of these real financial experts that aren't selling anybody anything, right? That's why we like Ed Slott so much. He's a CPA that gives us advice on IRAs, Roth IRAs, all of that, but doesn't sell any financial products whatsoever. So for Peter and I, we love that unbiased information sources that we have access to.
Yeah, names that outside of the industry that we are in, Chris, people may not be as familiar with it, but these are the people who are studying retirement, that are doing scholarly research on how to structure, how to plan, how to position all of the assets for the utmost potential for lasting financial confidence, a good projection and trajectory into the financial future, regardless of market volatility. And there are opportunities both on the income and the growth and the tax planning side, all bringing that together. That is what your game plan for retirement is all about, ladies and gentlemen. That plan that Chris McIntire can help you construct with that long-term vision, a personalized approach, diversified strategies to help you achieve your goals. If you would like to get your game plan for retirement put together, pick up the phone, give a call, 419-332-0532, 419-332-0532. So, Chris, we've got our plan in alignment, and then we experience some of this volatility. I mean, markets are down a little bit, not as significantly as I feel people feel like it is. Looking historically and over the past 1 year, 5 years, 10 years, it is a slight road bump here. But when we experience these moments of volatility, what are some of the opportunities that might be present if we have a plan and if we are properly positioned ahead of time?
Yeah, Microsoft, for example, is down about 25% for the year. When I was looking at one of my charts here within the last 48 hours of Peter and I doing the show here, is that an opportunity? That's probably an example of putting some money to work. Would you rather buy Microsoft when they're down 25% or up 25%? So, some of those dip type of stocks. And I think, most people would say, well, Microsoft's going to be around tomorrow.
So some buying opportunities.
Yeah, might be a buying opportunity, not an investment recommendation there, folks. We don't do that on the radio show, but just an example, and, like in 2008, when the real estate market crashed, those were massive buying opportunities for people to go in, buy a house, put some money into it, and then sell it down the road, when the market recovered. So those are examples of buying
It
opportunities.
was a rough time, but a lot of people made a lot of money during those downturns, Chris.
Yeah, our buddy David Gaylor bought a second home, down in Hilton Head that was a spec house and bought it at a significant discount. And eventually they sold it at a very significant profit. And, buying low, selling high. That was the idea.
Another one that you talk about often, Chris, is managing your tax liability. A lot of people have built up a good sum of money in tax deferred accounts. While we don't love to see market volatility, it may represent a pretty significant opportunity for tax management purposes.
Yeah, absolutely. So let's say that Microsoft stock that you have, for example, is down 25% and you own it inside your IRA account, right? You could shift it over into your Roth IRA account, and then obviously you would want it to grow and recover from that price decline. So you're paying lower your taxes on it being down 25% in value, and then shift it to your Roth, and then let it increase and make it tax free down the road. That would be an opportunity in a volatile market. Okay, the other side of that would be on those Roth conversions. Is working with your CPA and saying, look, I'm in the 12% tax bracket. How much more money can I pull out and stay in the 12% tax bracket and move that into my Roth IRA? We probably did more Roth conversions for 2025 tax year than any other time, and we're doing more and more of that. And I think we promoted here on the show, and also to our clients, that people that say, look, these guys are pretty proactive in doing that for their clients, and that's in their best interest. And it's, and for us, if you think about it, if somebody, we have $100,000 under management that we're getting paid on, and we move that into a Roth IRA, sometimes we got to take $20,000 for taxes out of that. So that's not in our best interest. That's in the client's best interest. So, and then obviously we want that to grow. So, sometimes we give advice, that is certainly better, much better for the clients than it is for us. That's the fiduciary part of what we do.
And I sometimes wonder, Chris, if people are not receiving that guidance for that reason as well. They're not getting that proactive tax management type of advice because the advisor might ultimately take a haircut in their pay as well, the assets under management. Like you said, if the taxes come out, the account value goes down. So I hope that would not be the case, but that has been a thought in the back of my mind. I know that you are very proactive on that, and with that fiduciary responsibility to clients' best interest first, making those kind of recommendations. And again, ladies and gentlemen, that's the kind of advice that you should have, that you deserve, is how to make the best moves at the best time for you and your financial situation. And you need to have a plan that gives the guidelines for that and helps you identify those opportunities. So pick up the phone and get your game plan for retirement put together. 419-332-0532, 419-332-0532. But Chris, the biggest mistake is probably the emotional decision making during the times and in the midst of market volatility.
Yeah, absolutely it is. And, we have always get a couple of clients that call when it gets real volatile, and it's not normally the most aggressive clients. A lot of times it's the most conservative ones, and sometimes, and I'm saying this jokingly, you got to talk them off the ledge, and say, look, you're down 3%. You want to get out of the investments, go into a money market being down 3%. I mean, sometimes they don't understand how this works, right? Dividends and interest are still coming in, being reinvested. And, many Americans, and I'm sure this is a global thing, invest emotionally, not logically.
Yeah,
right?
Mindset, right?
Yeah.
The volatility is part of the process. It's part of the investment experience. We've got to be prepared for that day to day. Market volatility will always be part of investing, and oftentimes is headline driven and in the moment with uncertainty. But some of the best days in the market happen right after some of the worst days. Some of the best months happen right after some of the worst months. So don't make those emotional decisions. Make decisions that are guided by planning. And having your game plan for retirement will give you those guidelines. Again, a personalized approach with diversified strategies, long-term vision, and the time horizon matters with the amount of risk that you might want to take or might be appropriate for your situation. So the question again, not if you are going to avoid volatility, but how can you plan for it? How much protection do you need against it? And the plan is going to give you those guidelines, ladies and gentlemen. Give a call to McIntire Retirement Services. Get your game plan for retirement put together. 419-332-0532, 419-332-0532. Again, a complimentary courtesy service to get your game plan for retirement put together so that you can deal with the market volatility, understand that it's part of the process, but enjoy life, have confidence that your money is being handled properly with the help of an experienced, qualified team of professionals. That's, again, the service there at McIntire Retirement Services, but the introductory offer, the complimentary plan, your game plan for retirement, just for calling 419-332-0532 or online McIntyre.com, McIntyre.com. Chris, always a great conversation every time we get the opportunity to check in with you. Thank you for keeping us level-headed, and a reminder, ladies and gentlemen, planning prevents panic. So make sure you've got that plan put together. Chris, thank you.
Hey, my pleasure, buddy. Yep. And what would Warren do?
Tune into Chris McIntyre's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.